warm welcome. Well, a very cold welcome from very cold London.
Thank you very much, and thank you for that kind introduction, and to thank you to everybody who braved the elements to come talk about everybody's favorite Luxembourg-based e-commerce player here. Yeah, I think everybody, and by way of background, my name is RJ Hadavi. I'm the lead consumer analyst globally for Morningstar. Yeah, I've been at Morningstar for about 9 years now, but been covering the e-commerce space for almost 20 years. Prior to Morningstar, I'd been at William Blair and Deutsche Bank and a few other stops along the way, but it's a space that's near and dear to my heart. I think that we can all appreciate that 2017 was a monumental year for Amazon. It's become one of the favorite pub stories among retail analysts and e-commerce analysts about where they were when the Amazon Whole Foods transaction got announced. Me personally, I was meeting with one of their top 5 shareholders who was unaware of the transaction as it was happening, had an intern run in middle of the session, let us know what was going on, and the look on the portfolio manager's face when he got to grill me on Amazon Whole Foods in real time was one of those days I'm not going to forget anytime soon. So anyways, hopefully most of you guys, I think most of the European audience was getting it right as you were heading into the weekend holiday, and hopefully it didn't ruin anybody's weekend for that reason. Anyways, the question that I got most often in 2017 is that, what is Amazon really trying to do here? On the surface, it seems like there's a lot of things going on in 2017. And, again, they can kind of seem like a lot of random, isolated events and really Amazon trying to push into other categories. But when we take a step back, I think there actually are, and while that's certainly true, pushing into new categories, I think there really are 2 common threads that we see with a lot of the moves that Amazon made last year. The first being that they're pivoting away from Prime member acquisition, at least in the United States, and more to Prime member engagement. And the second is I think that they're making their marketplace much more comprehensive and robust for third-party sellers. And we'll explain why that's important in a minute. But I think if I had to leave you with 2 points, that's I think what was really going on in 2017. I've broken down this presentation into 3 sections. The first is a deeper dive behind those 2 motivations and why those are so important. The second is where we're going to see that play out most directly in the consumer space, and that being the grocery and apparel categories. And then the third, and this is probably the most broad-based and pertinent to everybody, is what's the next steps? What are the ripple effects we're going to see across the rest of the retail/consumer/e-commerce category? So just taking a look at this next slide, this is just a partial list of what Amazon accomplished in 2017. It seemed to be almost on a daily basis we get a new news bit out of the company. Obviously, the big ones were things like the Whole Foods transaction. But on top of that, too, you have things like the partnership they did with Kohl's and a number of other things that are in the works. Any number of these things would have been a culmination of a multi-year process for most retailers, whereas Amazon seemingly was knocking these out on a weekly basis. Again, I think the key takeaway, if you look at every one of the things on the slide, apologize if it isn't visible here, but the common theme is you can tie it back to the idea of either trying to really get more out of the Prime members or trying to really tap into its and build a better third-party marketplace. Another way to look at it is this is our 5-year projections for Amazon's operating profit. Last year, the company posted 2.3% operating margins on a GAAP basis. And if we look over the next 5 years, we see that number getting to about 6%. Now, Amazon Web Services, which could be the topic of a whole other presentation in its own right, generates about half of that increase, that waterfall from the 2.3% last year to 6%. But then beyond that, I don't think we should discount the importance of both third-party and Prime membership growth, because I think both of those are going to be key contributors to the overall margin story and the long-term free cash flow story. We also, on the far end of the side, we also have some of the what we consider to be the emerging free cash flow drivers, and 2 in particular. One is advertising, and then the second is licensing some of those technologies. These will probably be important, probably the topics of future presentations as well. But today I really wanted to focus on the Prime membership growth and the third-party aspect of Amazon's business model. So first, let's take a look at Amazon Prime memberships. And I think this will go down as being one of the most disruptive developments in the retail and consumer space when it's all said and done. I think 10, 20 years out, This will be something that we really take a close look at and say this was a pretty monumental inflection point in the overall consumer space. It's something that Morningstar we like to look at. We do take a very long-term approach with our investment philosophy, and I'll explain why. That not only the Prime membership growth is important, but what it means longer term. So just kind of taking a step back and to give you a little bit of an overview, the Morningstar approach. When we assign a company to an analyst to cover, we don't start just dropping in numbers and playing around the model. We try to take a look at the company's competitive advantages and how it fits into its industry, how disruptive this could potentially be. In the words of Warren Buffett, what is this company's economic moat? And what we've seen in the e-commerce space is the idea of the network effect, where the more buyers that come to the platform, usually leads to more sellers, advertisers, and other, the other side of the transaction. What we found over the years is that this can be one of the most powerful economic moat sources out there. We also look at things like cost advantages, how powerful is the brand, does this company have patents or any kind of regulatory protection, are there switching costs involved? But what we found is that once a company has a network effect, and what we've loosely defined it as in the e-commerce space is that once you have the 10 to 15% of the population using your platform in a given market, that becomes a point where you have a lot of the first mover, the very affluent, the tech-savvy audience locked in, and that's the point where you do get those partnerships with those sellers and advertisers, and it becomes very difficult to unseat that player. This chart that I have on the screen right now shows basically from the early 90s through 2017 of what happened in what I consider to be developed markets between eBay and Amazon. And once upon a time in the early 2000s, you did see eBay actually have a larger user base, but that quickly shifted in about 2017 and 2007 and 2008. And a big part of that was that Amazon was able to not only lock in and drive a lot of traffic because they had 1 or 2 day delivery coverage across a lot of these markets. And as a result, ever since then, certainly the company was helped by the recession, people looking to stretch their budgets, and they found Amazon as a viable opportunity in that regard. Ever since then, we've obviously seen Amazon's user base significantly outgrow eBay. What's interesting, too, is if we look across the globe, we typically see that what we consider to be wide moats, and the way we think about that is that these are the companies that 20 years from now, we think that these companies are going to continue to generate free cash flow, returns on invested capital above their weighted average cost of capital. Out of all the things that we look at, all the different sources, what we've typically found is that a network effect is one of the most sticky competitive advantages in the market today. And really, I think that the things we'll talk about in terms of Prime memberships and we'll walk through why that's so important and what that means and how that network effect will play out over the next several years. So again, I apologize if this isn't legible on the screen, but one of the analysis that we did when we started trying to break down the Amazon's 2017 is try to separate the different revenue lines that the company has. Starting in 2017, the company broke down its revenue sources into 5 different sources, or really 4 different sources, and now has expanded to a 5th with physical retail. But effectively, you can start and take out Amazon Web Services, which is a whole nother business. Right now, it's running at about a $12 billion, or more recently, it's running at a more closer to a $20 billion run rate revenue business, but with operating margins of 25%. If we strip out that Amazon Web Services component of that, that leaves us with both North America and international retail, which is coming in at about a 1% margin. Now, again, if we take that the next step further, you have about a 3-4% margin in North America, whereas you're running at about a 2 to 3% loss in international markets. A lot of that is the company's investment in India, which is running at about a $3 to $3.5 billion run rate. But I think more interesting analysis, we take a look at the different revenue streams within Amazon's retail businesses, and there's 4 of them. One is where Amazon is directly selling products to consumers, where they are the retailer, where they receive products from a vendor, they now take the inventory risk and then sell that directly to consumers. The second is third-party seller services. So not only the commission they receive from a third-party vendor who's selling on Amazon's marketplace, but also some of the fulfillment services that Amazon has embarked on. The next is retail subscription services, and a big part of this is Amazon Prime memberships. Where again, just the fees they generate on that. There's also some content costs that go along with that as well. But this is generally speaking just the fees and other subscription-based services that Amazon receives. And the fourth and more nascent category is this other group, which is both advertising and Amazon's co-branded credit cards. I think the most interesting takeaway from this, and it it confirmed a long-standing suspicion that we had, is that Amazon is generally losing between 5 and 10% on every product they directly sell. Now, that's not a blanket statement. There are some categories where they do generate profits, and this is, again, being skewed by some of the moves they're making in international markets, particularly India, where, again, they're using a lot of the products they sell as loss leaders. But that's pretty interesting in my mind that the company is, in our mind, and the only way the algebra works is if the company is losing profits on every one of the products they directly sell to peers. But what's interesting is if you take a look at the other two categories, the two that I want to dive into here, both Amazon Prime memberships and third-party sales, that's where you see the company drives the bulk of its profits. So in terms of third-party transactions, so again, where a vendor is just using Amazon's marketplace to sell directly and not selling directly to Amazon, it's just selling directly to consumers on Amazon's marketplace. We've actually found that between the commission that Amazon charges as well as some of the tack-on services for fulfillment and other things, it ends up being about a 21% margin transaction for the company. Similarly for Amazon Prime memberships, and again, this gets a little bit fuzzy in terms of where the accounting on it, because the way that we've calculated is that the shipping cost for Amazon Prime products is going to end up going through first party, because that's mostly being sold through Amazon Prime or through Amazon itself or through its third-party members. So some of the shipping costs get allocated to elsewhere. But if you look at just the fees less the content costs that Amazon's paying, it's almost close. It's close to a 30% margin that they're generating in that business, and that's pretty important because I think, again, that's where the bulk of Amazon's profits on its retail side are going to come from in the years to come. And I think the key takeaway, again, tying it back to Prime membership, this is where we've kind of calculated what our best guess as to how many Prime memberships there are in the U.S. today. We think the company ended up with about 88 million Prime memberships in the U.S. In 2017. Now, that's not exactly a one-to-one for households. Our best guess is that's about 65 to 70 million households. Generally speaking, there's about a 1.2 ratio, Prime memberships per household for things like Amazon student memberships, or multiple memberships in a household for whatever reason. So that's about 65 million households, again, almost 90 million memberships. In a population of 320 million individuals and about 120 million households, it's pretty clear that Amazon is going to start running out of white space for actual Prime member acquisition and is really going to need to pivot to engagement. These estimates here are projections through 2021 in terms of Prime memberships, and some of this does assume that the company is going to start to see a pickup in what we call Prime business subscriptions, but really we see them more or less topping out at about 110 million actual consumer Prime memberships. What this next slide shows is that what the company is actually able to generate in terms of Prime or retail subscription revenue, and so that's that top line. So the company, what we're seeing is actually starting to pivot a bit and finding ways to charge more those Prime members more and more. One way to think about it is instead of that $100 a year that you're paying as a Prime member right now, with things like music subscriptions or Audible, the audiobook business that Amazon has, you tack on those things, all of a sudden you're paying $150 to $200 a year. We believe that it's going to be a big year for Amazon in 2018 in terms of retooling its Amazon Fresh online grocery platform, where you're also going to start seeing that be between $8 and $10 per delivery or per month. You can start to see that all of a sudden, instead of the number of Prime members coming onto the group driving that profitability on that, it's going to be more the services that get tacked on. Another way to look at it too is a little bit like the Costco or the Warehouse Club model, where again those companies generate the bulk of their operating profit through these membership fees. Well, Amazon's certainly like that, but I think that Amazon is unique in the fact that there's a lot of other ways for the company to monetize and find new ways and new pricing tiers for Prime membership. So that's kind of the key takeaway here, is that it's not just Prime members coming on board, it's the engagement they're getting out of that I think is going to be so important. And I think that ultimately explains what they're doing with Whole Foods, which I'll touch on a little bit further in this presentation. I also wanted to touch on the idea of Amazon becoming more of a third-party marketplace. What this slide shows is the percentage of third-party units sold on Amazon's platform. And as we've seen, it's been slowly moving towards a third-party marketplace. And right now, about half the products sold on Amazon are sold directly by vendors and suppliers. Over time, we see this getting to about 60, 70%. It's tough to get a good idea of exactly when that's happened, but I don't think Amazon is ever going to be 100% a third-party marketplace like we see with an eBay or an Alibaba or Mercado Libre down in Latin America. Ultimately, I think that they want to keep about 20 to 30% of the products coming from first-party, and a big part of that's going to be private label products, which is something I'll get into as well. I do think Amazon's got a tremendous private label opportunity. I think they'll continue to do that, continue to put a lot of investment and a lot of emphasis on them in the years to come. What this next slide shows, the longer line here is actually the year-over-year growth and the number of third-party products sold on Amazon's platform. But the top line, and again, the only reason why it's a shorter line is because we only started getting disclosure on this at the beginning of 2016. But what that shows is the seller services. So what Amazon is generating revenue from its actual sellers on a year-over-year basis. And that's continuing to outpace the number of units sold. So I think that just shows you the power of the network effect here, and that the company is going to be able to continue to monetize that. And I think where this is going to show up in a lot of instances is categories like apparel, where the logistics get pretty complicated, particularly in where there is so many high returns, and Amazon can kind of be the leader and their reverse logistics or returns partner in that case. So we'll walk through a little bit more of that as well. But this is, again, kind of the proof that we're starting to see them monetize the third-party marketplace or third-party sellers in increasing fashion. So again, this is the second part of the presentation where I want to dive into the two categories that I think Amazon is going to be most focused on in 2018, and that being grocery and apparel. Again, despite being one of the largest retail categories in the market, online grocery is not something that's really caught on the North America or U.S. market, and really there's three reasons behind that. One is it's perceived to be costly. Usually when you start talking about the add-on fees or surcharges that get tacked onto your order, it does become a costly endeavor for most of the U.S. consumer at this point. The second thing is that there's an inconvenience factor. The U.S. is not built like some of the other markets that have seen online grocery adoption. South Korea being the number one, but also markets like the United Kingdom. There's a few other European markets where you have enough density in given markets where it makes some sense. Because we really don't have the density that some of these other markets, the U.S. does, the U.S. doesn't have the density that some of these other markets, it does lead to inconvenient drop-off times, late at night, early morning, that can be a hindrance and ultimately take away from the convenience aspect of the story. And the third thing is that just there's been some, there's questions about where particularly in the fresh food, where those products are coming from, and there's been a reluctance from among U.S. consumers to really embrace that. Now, I don't think that we're ever going to see, online grocery, be completely replace physical grocery stores, and I think that's a big part of what Amazon recognizes, that, there's no way to completely replicate that in store. But I do think that Amazon's purchase of Whole Foods will help them to break down a lot of the barriers that we've seen in this case. And again, the idea that you need to get more and more engagement out of your Prime members, and one of the great ways to do that is to move into categories that people make more frequent purchases. And I think that Whole Foods certainly fits that bill. And I think you're going to continue to see more and more announcements about Amazon and Whole Foods, and probably a more major retooling of the Amazon Fresh program at this point. And it's not just limited to Whole Foods. The other Amazon physical stores tests that we're seeing right now also open up an opportunity to really engage with those consumers and increase not only the number of transactions being made, but also find new structures for Prime member tiering. So this is just kind of a quick overview of how we see the grocery category playing out for Amazon. We estimate that it was about a $26 to $27 billion category for Amazon if you combine what they're selling both on their online platform, but also what they sold through Whole Foods. I expect that to grow at about a mid-teen clip over the next 5 years. That's going to outpace, generally speaking, the overall online grocery category, which we have kind of in the low teens rate. So we do think that Amazon will continue to take market share there, but continue to grow both its online and in-store presence as well. And I think what's going to be very interesting too here is that not only Whole Foods but also some of the secondary concepts that we have out there. I'm guessing most people who follow Amazon saw the news that after after much anticipation, the company finally opened up its Amazon Go convenience store in Seattle, and the store, it's a pretty interesting development where, again, you walk in, it's cashless technology. Anything you pick off your shelf will automatically be added to your basket. You simply walk out, and then it'll be charged. What I think is interesting that this does encourage a lot of engagement. It forces you to have another Amazon app on your mobile phone. And I think that that's another way that they can directly, the company can directly market to you, encourage more and more engagement, and keep you locked into the Amazon ecosystem. Same thing for Amazon Books, and this is a couple pictures from the Amazon bookstore in the Chicago market. What's interesting about this is that when you walk in the door, the first sign you see is, this is the price you pay if you're an Amazon Prime member, and you'll pay the same price as online. You're going to pay more as a non-Prime member. So this is, again, not only getting people into the fold, but getting more and more engagement out of them. I think what's going to be interesting to see is that right now, you don't have things like cashless technology implemented in these stores, but our conversations with some of the store managers, Amazon bookstore managers, it seems to indicate that we're going to be headed in that direction pretty soon. As soon as they kind of refine the technology, and again, just offers another way to engage. You'll probably see some other sort of membership tiering come out of this as well. And again, the idea of raising that average price point that a Prime member is paying in subscription fees each year. And again, the idea that the private label offers a huge opportunity for this company. Right now, we estimate that private label represents between a $2 and $3 billion business for Amazon, and that's across all categories, whether it be grocery, whether it be apparel, and electronics are the three big ones. And that represents about 2% of the company's non-AWS revenue at this point. Now, if we look at 5 years out, we see that being closer to a $12 billion business and representing about call it 7% of the overall mix. I think again, grocery is going to be an area where we see a lot of growth there, where you're starting to see Amazon kick out kind of the third and fourth brands in a given category at the Whole Foods and start to replace it with some of their private label brands. And so I think this will be a tremendous opportunity for them, and also one that allows them to offset the costs of grocery. Again, I don't think this is going to be a profitable category for them, and I think the end game is getting more out of the membership fees, but I don't think they're going to generate a lot of the profit through that. And one of the ways they can offset the cost is becoming a larger private label presence. So the second category that I think the company's focused on this year is apparel, and I think it's been very interesting, to see this develop, because this is a category that no mass merchants has ever really done well. If you think about Walmart and some of the other large mass merchants, it's been very hard to take a brand that's associated with kind of mass merchant and low prices and shift into the kind of the world of fashion. Right now, Amazon is kind of lockstep with Walmart as the largest apparel retailer in the world at this point. And I think you'll continue to see Amazon outgrow this. What I think is interesting in this is that we're starting to see partners that would have never partnered with Amazon in the past. So the companies like Nike and some of the other more fashionable oriented retailers start to explore partnerships with Amazon. And while I don't think they're ever going to put their high-end merchandise on there, I think it does make sense for a lot of these players to participate with Amazon. One of the big announcements the company made in 2017 is the idea of Prime Wardrobe. And for those who aren't familiar with this, what it is that Amazon will send you a box of anywhere between 5 and 15 products, and based on the percentage of products that you keep, you get a discount on that. What Amazon's doing here is effectively using that that discount to offset some of the shipping costs with that. But the more important measures, they're actually trying to put some structure behind product returns. In the apparel category today, approximately 40% of products sold online get returned, and that's become a huge burden for a lot of the vendors out there. So I think that this is a measure to keep, if Amazon can present a solution that they can keep their reverse logistics costs down, I think you're going to see a lot of apparel companies be more willing to participate with Amazon. There's also tremendous private label opportunity here too, and this is one where I don't think Amazon is necessarily perceived as kind of a low-cost merchant. This is one where it generally skews to a more affluent audience, particularly among Prime members. And when you add in things like body imaging technology and some of the manufacturing things that Amazon's invested in, We think this has a higher probability of success than some of the other mass merchants that have moved into apparel in the last couple of years. Again, apparel is one of the fastest growing digital categories, and you're starting to see market share gains for Amazon. And over the next 5 years, we think that this is going to grow, explosively for the company. We think it's going to be a mid-20s growth rate over the next 5 years, and probably put a lot of pressure on traditional retailers. However, we do think that those companies that are more vendors, they generally seem to be more agnostic. Obviously the super premium luxury names are going to be reluctant to partner with an Amazon, but we've started to see, kind of the more upscale apparel, fashion, footwear brands start to, at least toe the water and start to get into this. So again, I think this is going to be one of the stories to keep an eye on in the next couple of years, is Amazon positioning itself to be a much more robust apparel retailer. So this leads me to the third part of the presentation. We just got a few more minutes on this, but I wanted to quickly talk about kind of the ripple effect. What are the moves that the company made in 2017 mean for the rest of the retail category? And kind of take a look at some of the categories that have been in the news more recently as well. So, who's the company that is best prepared to compete with Amazon? And this one's not a surprise, but I do think, Walmart is the one that at least if you put the pieces together, it can offer a viable competitor to Amazon. Now, I don't think it's going to completely disrupt Amazon, but I do think there is a tremendous opportunity. We talked about the fact that there's 90 million Prime memberships and 60 million households. That still leaves you with a lot of white space, particularly among younger families, and I think that's where Amazon or Walmart is clearly focused on right now. They have the combination of the relationships with the suppliers, they've got the logistics capabilities, and they've got Mark Lowry, who, at least for the time being, there's been some rumors about him potentially leaving, who's built a pretty good team with the Walmart e-commerce operations. So I think that they offer a viable solution. The one problem they've run into, though, is that it's very difficult to unseat a Prime member. We estimate that right now, about 90% of the Prime members continue to keep their Prime membership year in and year out. And I think a lot of that has to do with some of the additional benefits that they get. Until Walmart really has a content offering, and that might require some sort of partnership with the likes of a Netflix or a Hulu to really drive that, that's going to be very difficult to get somebody to trade in their Prime membership. Beyond that, Costco and Kroger are kind of the next tier that we look at. The companies that do, not only have the scale, but also have gas. Gas is one category that Amazon obviously is not broken into, and at least until Jeff Bezos figures out how to deliver gas by drone or something to that effect. But at least, that gives these companies, some protection. They've also, both Kroger and Costco, have done a good job building out their online presence, and so it keeps them competitive. They generally price pretty competitively with Amazon and have done a good job on the logistics and e-commerce side. However, down the road, there are some risks to that, and those being the rise of electric cars. If that goes away, that gas component becomes a lot less important. The other thing, too, is that if you look at the average age of a Costco member, which typically runs in the late 50s, as opposed to an Amazon Prime member, which is in the upper 30s, there could be the risk of an aging out of the Costco member and, see the rise of Prime memberships from that. So I'd say that they're protected, at least near term, but something that there are longer term threats there. The categories that we do think are the names that we do think are the most exposed to Amazon's pushes into grocery and apparel. I think a name like Target, we're really having a hard time seeing how this company survives or continues to grow without sacrificing profits. And frankly, I think seeing operating margins in this business contract to kind of the 4% range that Amazon does in its North America retail business is a safe assumption on that company. Also, traditional grocers, right now we see them scrambling and realizing that we are going to start to see, I think for the first time, some adoption among U.S. consumers about online grocery, and they're really scrambling to refine their playbook. And again, the same idea that as Amazon and Walmart compete on price in this category, it's going to be very difficult for a lot of these players to generate any kind of real profitability. Now, looking beyond the grocery categories, I think it's interesting to look at a couple other names. Kohl's is an interesting one. where the company's running, or Amazon right now is running a test where you can not only Amazon Prime users can not only return their products at locations in Chicago and Los Angeles, but they're also running effectively a Geek Squad, a version of Geek Squad like Best Buy has, called Amazon Home Services out of that group. And I think that's another one of those opportunities that can really start to drive engagement out of Prime members. So I think that's an interesting name to watch out for. We saw it a little bit in the fourth quarter numbers with the big comparable store sales that they generated. So that's one of those ones. Anybody who kind of would fit into the home services market, I think, could be disadvantaged as Amazon really starts to push that with Kohl's. And then the last one, and I've got another slide that kind of walks into this, but I'd say there's 4 categories that have gotten a lot of focus from the media in terms of the next steps beyond grocery and apparel. And I'd say that would be pharmacy and medical supplies, auto parts, home furnishings, and beauty. I think the first 2 that I mentioned, both pharma and auto parts, while there's been a lot of headlines, and obviously Amazon even makes any kind of announcement or even sneezes in the direction of pharma companies right now, it seems to have an impact on those stocks. However, the reality is there's still a very arduous licensing process that the company would have to go through, both at the federal and state, and even have to get their trucks and facilities licensed. And so I think that becoming an actual pharmacy company or PBM would likely require some sort of partnership or an acquisition. And I think the company's probably got enough on its plate with Whole Foods right now before jumping into that. Again, I think most of the moves we've seen have been them going more towards medical supplies as opposed to actual pharmacies right now. Auto parts is another interesting one too, where I think this company has generally done it's obviously an area of focus for them, but it's a very difficult group to satisfy. Typically, particularly among the professional auto parts contractors, that group, when they have an order come in, generally speaking, you need those parts within a half hour. And even with Amazon speed, they haven't quite gotten that down to that same level. So I do think that some of the pressure we've seen on the traditional auto parts retailers, both in the U.S. and in Europe, has been a bit overblown. That said, home furnishings is a group that I think is definitely in Amazon's crosshairs. It hasn't got nearly the attention as Amazon Go or some of the other retail concepts, but the company's actually opened up a couple home furnishing showrooms, one in North Carolina and then one in Las Vegas. So it's clearly an area where they could see an opportunity to expand their retail footprint as well. And then the last one is beauty, the idea of beauty and cosmetic products. I think this is one that dovetails nicely into that Amazon, that Prime Wardrobe initiative that they're looking at this point. And so the last couple slides I want to just quickly go over. I mean, one of the things that we've looked at in terms of Morningstar's research, we've come up with a 6-point checklist to analyze the exposure of, or how insulated a retailer or retail category is to Amazon's. And I think this is a good sanity check if you'd like to use it in terms of, thinking about how these companies might be disrupted. What is the pricing in this category compared to, online retail, or how transparent is the pricing, I think is a consideration. How available are the products? Is it something where, the products, are readily available on the shelves, or something that can only be done online? The immediacy of need. Is this something that you need right away? For example, home improvement is a category that we've always thought is fairly well insulated because, if something breaks at your house, generally speaking, you're going to need that fixed right away. And so there's an immediacy of need. Is it a specialized product? Is this something that, again, you need that associate at the store to help you guide you through the decision process? Is there an experience aspect? And I think this is why a lot of the apparel retailers have done, at least stayed in the conversation, because there is an experience aspect that goes along with that. There's an element of entertainment that goes along with the shopping experience. And then the last one is just how realistic is it to ship these products? Are they bulky, heavy products? Is there restrictions outright? There's some home improvement categories that just can't be shipped. And so I think that's a good barometer. And again, here, this just kind of shows what we're seeing with auto parts and pharmacy. We see these as being very well protected, and then home furnishings and beauty being more exposed. So that's kind of just the quick overview of the moves that Amazon made the last year. I'm not sure how much time we have for questions, but I'm happy to answer anything that you might have on Amazon, broadly about these topics or anything else that might be in the news right now.
RJ, thank you very much. It's Daisy here. We can see you. I will open the floor up for quick questions. There's a gentleman in front of me. Anyone else after Sir.
Okay, so if I have understood correctly, Amazon makes a loss on every good it sells through its platform as a retailer. Is that not a textbook example of dumping, and is there a risk, reputational or else, for the business?
It is, and again, I think that there's some nuance with that number. I mean, I think that every one of the, if you look strictly at North America, it's probably closer to break even in that market. So they are making slight profits in certain categories. I think that consumer electronics, they're making some small profits in some of those categories, and especially obviously the ones that they're selling through a private label. However, they're using a lot of those as loss leaders. I look at it as not too dissimilar to what goes on at the warehouse club market, where again, those companies are generally making about break even on the products themselves, and generate the bulk of the profits from that group through the membership fees. So something like Costco, 85% of the membership fee, or 85% of its profits come directly from those membership fees, where they're making effectively no profits on the products they sell themselves. Now, internationally, that's a little bit different, where it's still, we talked about engagement. I think the customer acquisition is clearly still very important in some of the markets that targeted Europe. We're starting to see the same ramp of Amazon Prime members that we saw in the U.S. from approximately 2011 to 2014. We're starting to see that really take place in Europe as well. What's interesting there is that it's actually tucked away in the footnotes in the release, but it does seem to hint that they are profitable in Europe at this point. I wouldn't say very profitable, probably right around 1%, but it's pretty clear that they're finding ways to monetize that. Now, the last one, is India, where again that they've subsidized a lot of that right now to really drive that base. That's the one market that we see globally that doesn't have a kind of a dominant player that's established a network effect that's keeping other players out. I mean, if you think about it, Alibaba has not been able to get to North America because Amazon effectively had them boxed out. On the flip side of that coin, Amazon's more or less capitulated the China market because Alibaba's dominance. Now, India is where you just don't have the dominant player. Right now, it's a two-way race between Flipkart and Amazon. And I think that with a competitor there in that race to kind of get the saturation and the scale among that user base, and then drive sellers from that, so it does make sense. But again, I think the idea is that that generally speaking, they do are break even at best in the developed markets. And again, that's why it's so these membership bases plus third-party sellers coming in. Again, I think that Amazon does see the value of being more of a third-party marketplace, where the inventory risk falls on the vendor themselves, and they can generate a lot of profitability through that, recognizing that right now a lot of retailers and other consumer brands just don't have the balance sheets to invest in the same logistics capabilities. So I think that's kind of where it is. At equilibrium, I think that it's they'll generate some profit out of it, but a lot of that the loss they're making right now are particularly in markets where they're still trying to build out their Prime membership base.
RJ, thank you very much. We've got a question at the front. We mind handing the microphone to the front? Thank you. Anybody after this gentleman? RJ, just before that question, can I ask, some of our audience members were trying to photograph your slides, which I'm sure won't probably come out terribly well. Are we able to get copies of your presentation online for people who are here?
We could certainly do that, and I believe we actually have a booth at the conference too, where we've included. We did a longer form piece on this, diving in much deeper than some of the stuff we talked about. It's about a 60 to 70 page report. I think we've got a few copies of that, and certainly we have some of our sales members that are there. But we could probably get a copy of the presentation as well. But a lot of it's contained in this report that we can get off of Morningstar's research portal.
That's wonderful. Thank you very much, sir at the front.
I know you said when you showed your operating margin bridge that AWS is a separate presentation, but I have a question on it, which is, when you talk to people that don't own Amazon shares, the bear case nearly always boils down to you're not a believer in AWS becoming a software business. They see it as a capital-intensive, cost of capital plus replacing servers all the time infrastructure business. So has there been any change over the course of the last 6-12 months in your mind in both the debate with investors and the information that Amazon's giving in order for us to have a different view about the future if you are a bear on AWS?
No, it's a great question to ask. And what's interesting about AWS is, it's kind of been a black box in terms of, where that profit's coming from. I mean, you see that 25% margin, and, again, there's a lot of other things going on. They're generating 25% operating margins, but yet in the cloud storage and the cloud compute businesses, so EC3 and EC2 and S3, which are their cloud storage and cloud compute businesses. I mean, the company likes to brag about how many price cuts have been in these businesses. And at the end of the day, these are commodity businesses. And so the likes of Microsoft and Google, and even globally, if we look at somebody like an Ollie Cloud getting into this business, on the more commodity functions like cloud storage and cloud compute, we absolutely see margins going down for these businesses. I think that that's going to continue. It's going to be a competition. And even as we start to see the likes of Google and Azure really start to build out and becoming a larger presence, for enterprises, which up until this point, AWS has really been the only player in town. We're probably going to continue to see prices on the usage rates for those type of functions go down. However, there's a lot of other things embedded with AWS that I don't think gets enough credit, and I think that will continue to drive profitability for this company. And again, we're not expecting Herculean margin expansion out of this segment over the next 5 years. I have the operating margins in the segment growing from 25 to 30%. That's quite a bit below what I consider to be the bowls on the AWS side. I've seen operating margin projections as high as 40% in this category from other sell-side providers. But there's a few things embedded within the AWS category or segment that I think are worth monitoring. The big one for us is something called AWS Marketplace, which is where if you're a small software developer or other content provider through AWS, you have the ability to sell to other AWS customers. And there's actually a landing page for it, and I encourage you to take a look at it. Effectively, it acts a lot like Amazon's third-party marketplace for its retail goods, where they take a commission on that sale and it ends up being a very high-margin transaction. Same thing for this. It's not structured the same way in terms of the commissions because sometimes it's based on usage rates, but effectively Amazon is just taking a commission on that sale from a small software provider, and given that it's got a wide reach, you do see a lot of people flock to that. We see that this is probably close to maybe between 5 and 10% of the revenue of AWS, but our estimate is it could be as much as 20 to 25% of the operating profits of this business. It's something that doesn't get its full due. So even as you start to see some of the more commodity-like functions within AWS start to continue to see margins and those go down, you have this large AWS or potentially very lucrative AWS marketplace segment that could drive profitability. There's other things too that I consider to be kind of more mission-critical services that enterprises would want to pay up for. Security being a big one. But then also Internet of Things. I think there's a tremendous opportunity for Amazon to effectively, with commercial enterprises, to automate their warehouses and kind of be the neural network for those type of things. And we're certainly seeing a willingness among enterprises to pay up for that. So again, I think it's reasonable to assume some margin expansion and that this category will continue to be the dominant force. This is where there's an element of almost one low-cost provider. Amazon is the low-cost provider, and so that they continue to drive new customer growth through that. But then also at a certain point, there's going to be a switching cost element where Amazon is going to, it becomes very difficult for an enterprise to switch to another player. For example, somebody like Netflix, which does their menu screens through AWS. This is a company that would love to, decouple and not be a partner with Amazon at this point. But because, so much of their traffic and so much of the success of their platform is dependent on it running smoothly through AWS, they've kind of been forced to keep that. And I think a migration would be, potentially risking loss of customers. So, it's a great question to be asking, and it's one that we spent a lot of time looking at in terms of the profitability. We've done a big piece on the overall cloud space where we highlighted not only AWS, but Microsoft and Google, are one of our SaaS, our head SaaS analyst, Rodney Nelson, has done some great work on this. And again, there's a long form piece that kind of dives into this and other competition aspects within this too. If you talk to our sales force, they can certainly get you a copy of that piece as well.
RJ, thank you very, very much. And I'm afraid I am going to have to draw it to a close because we have rather dramatically run over time. Apologies for the late start. That was our fault. But many thanks for your presentation and answering our questions.
Absolutely.
Really been very interesting. And thank you. And we'll talk to your colleague about getting hold of those slides. But thank you very much from us in London.
Appreciate it. Thank you.
Right, we will move on now to US healthcare risk and opportunity. Now, without any further ado, going to very quickly pass over to Rob Smith from Capital Alpha Partners, talking about health risk.
Thank you very much, and thanks to GIRC for having us, and thank you all for sticking around. So I'm Rob Smith with Capital Alpha Partners. Get up to our slides here. Just a brief overview of our firm. We are a policy and political research firm based in Washington, D.C. All told, our team has 175 years of combined experience in the D.C. arena. So there's very seldom that there's an issue that we don't have some deep institutional knowledge on, or have a contact that could get folks the answers that they need. I don't put the president's internet habits in that category, but we generally are able to take care of any sort of need across sort of the whole investment spectrum, anything that touches DC. So this is a bit of background about me. I won't spend any time reading this to you, and I'm also going to be joined by Byron Callan, who covers defense, industrials, and trade as well for us. So diving right in. So you can see here that the federal government is a huge role in healthcare growth and healthcare spending. Over the past several years, we're seeing the first time that the government has become the largest source of healthcare coverage. That switched over right about the time that the ACA was passed. There's several different divisions and sources of coverage. We have the Defense Service, we have Medicare for old people, Medicaid for poor people, we have the CHIP program for children. So just a very diverse set of programs that provide healthcare coverage in the United States through the government. We can see there that ACA plans, that's about 10 million people enrolled in 2015. Employer-sponsored plans, that's another big source of coverage. They take advantage of about a $250 billion tax break that we provide every year for the expenses that they pay for their employees. The number of people covered under government programs now is 165 million people, and that's set to grow very quickly over the next several years. You can see here just a sort of alphabet soup of different committees, different agencies that are involved in our healthcare system. Each one of these agencies and each one of these committees has their own agendas and own personalities, so it's very hard to get agreement on many of these issues that they have to deal with. So you can see, and then of course you have the industry lobbying groups too that have a great amount of influence on legislation and regulation in the United States. You can see here just sort of to break down further the sources of coverage in the United States. You can see there that our public spending on healthcare is set to grow at a very quick rate all the way through 2023, whereas the private coverage sources are looking to drop. You can see there too the newly eligible Medicaid population. That was about 12 million people that were added to Medicaid. Most people think of the ACA as just adding the exchange coverage, but really it had a much bigger impact on the Medicaid population. That's set to grow as well as our Medicare population as more folks age into the 65-year Medicare eligibility age. And then you can see here too that healthcare is taking up a greater and greater portion of our overall economy. You have there healthcare growing, about on pace with Social Security, but is definitely at a higher level. Whereas we have less money that we're spending for discretionary items, things like government research, education, defense, and whatnot. So really, if you're going to boost any of those things that the government does, you need to find a way to crack down on our entitlement spending for healthcare and Social Security. So as far as how all of this comes together, obviously Congress has a big impact on the healthcare space. Pass laws all the time that have to do with healthcare. We had a big budget bill that was passed just at the beginning of February. It's ostensibly a bill to allow the government to spend more money on the appropriations process, but 140 pages of that 250-page bill were healthcare provisions. So almost anything that goes through has healthcare implications. And we tend Congress tends to work under a deadline. It doesn't work well, but it tends to only do things when it's under a deadline. So you have these catalysts like we have to pass a budget bill or we'll have a big decrease in military spending. We've done that several times, including the bill that was just passed in February, like I said. So you can see that there's quite a big impact on the healthcare sector because typically Congress looks for healthcare cuts to fund other things that it wants to do, like boost military funding or boost NIH spending. Then we have a few catalysts coming up for the rest of the year. We have our March 23rd spending bill, which is being eyed for some Obamacare stabilization provisions. You have the FDA animal drug user fee reauthorization that needs to happen. That's likely to include a lot of FDA policy riders, including establishing a new diagnostics center at FDA, which is going to be a big deal for both the labs and diagnostics sector. And then also we're looking at improving our opioid response. The budget bill that just passed includes $6 billion for opioid programs, which is still yet to be doled out. Congress is looking to do more there, so we're looking to see sort of extended coverage for Medicare, medication-assisted therapy products, looking to see some expansion of mental health coverage as well as part of that. And then, of course, we have our current budget deal that expires at the end of September. So we're going to have, or at the end of September 2019, that should say. So there's going to be another catalyst that comes up there, too. And then on top of sort of the legislative process, we have this big, and this slide didn't translate so well on the on this format, but we have a huge amount of regulations that go through CMS every year. There are 9 different payment rules that CMS updates every year. You have a proposed rule and a final rule that dictate how much certain procedures are reimbursed by. They dictate coverage, either expansions or retractions, and it can have just a huge impact on investments. So that's absolutely something to keep track of. And then you can see here, as far as like how we spend our money on the Medicare program, it's $675 billion right now. You can see that Medicare Advantage, that's a private offering where you have essentially private plans that are providing Medicare benefits. That's growing at a great clip. I mean, you can see it's about 30% of overall Medicare spending right now. That's probably going to grow fairly substantially going forward. People tend to really like those plans. It's a really attractive space to play in. On the investment side as well. Then you have hospital inpatient services. You know, those are we have hospitals are shrinking somewhat in the United States, but they still represent the largest component, outside of Medicare Advantage of spending. And then you have physician payments, and then Part D drugs. That's also growing very quickly. So. Then on the hospital outpatient services side, that includes all physician administered, in the physician payment side, that includes all physician administered drugs. So Part B drug spending, that's growing at a great clip that actually eclipses the Part D prescription drug spending. So even though it's not as high right now, that's going to be a bigger problem in the future. So, there is a lot of noise out of Washington. We have a president who essentially started his political career Twitter trolling Barack Obama, and his behavior hasn't really changed now that he's president. So there's always going to be a lot of noise. This White House has been very unpredictable. They say that the most powerful person in Washington is the last person to speak to Donald Trump. So his opinions and moods and things that he seemingly advocated for change by the day, almost. But there are some things that we think are, very, very likely to continue and that are sort of, real. The drug pricing debate is going to continue. That is something that the president is very passionate about. It appeals to, a wide swath of the political landscape. It's a very populist issue. And then Democrats are certainly on board for making huge changes there. We are also in the process of fully overhauling the way that we pay physicians in the United States, and that's through that MACRA law. It's the Medicare Access and Children's Health Insurance Reauthorization Act, but it's just called MACRA in the United States. And then also, as part of macro, we're seeing a large shift from fee-for-service, meaning you pay by procedure, pay by product in the United States. That's typically how Medicare has operated, to more of value-based purchasing mode, where you have bundled payments that you're paid by the overall procedure and things like that. ACOs as well, where you're responsible for the health of a whole population, not just that particular patient that you're seeing that day. The Trump drug proposals so far, and if you can't see those, and we're happy to give you our slides. Courtney Oldham in the back has copies of both mine and Byron's presentations. But you can see here that there are a number of ideas out there, and this is just the administration, what they've put out so far. A number of ideas, and a lot of them touch not necessarily drug pricing, but others in the distribution chain, like PBMs are under a ton of pressure now. Generics, there's some talk of revoking the 180-day exclusivity for the first generic, which is generating a lot of interest on Capitol Hill, because that would score as a cost saver that you could use to pay for other things, as we mentioned before. And then there's some talk of changing the reimbursements for the new physician administered drugs as well. And then also, apart from these drug pricing proposals, there are a lot of bundled payment implications for pharma as well. We have the oncology care model, where instead of being paid just for administering drugs, chemotherapy drugs, a cancer clinic would be paid for all of the services that a particular patient, or be responsible, for all of the services that a patient utilizes over a 6-month episode of care. So there's a lot of sort of a lot of changes going on in both sort of like the straight up drug pricing area, and then sort of like the reimbursement system as well. This is provider payment reform. As I alluded, we're having a big shift from Medicare, from fee-for-service to pay-for-value. Right now, it's about a third of all payments are going through some sort of value-based payment stream, whether it's bundling or ACOs or what have you. We already pay all of our dialysis reimbursements are done on a bundled payment basis, for example, too. So, I mean, you can see that there's the general idea, the general concept there. So I think going forward, whether you're an investor in a medical device company or pharmaceutical company, you really have to consider how they would fit in this bundled payment environment. Are they priced such that they could be attractive for somebody who is facing this sort of payment risk? Could they provide better outcomes than other products that are out there now? One of the big sources of spending, and one of the things that can really kill your bundled payment arrangement, is having readmissions or having to do revisions on a procedure. So things that provide a good clinical advantage over others that are out there. That's something to really consider. And then management too. Depending on who you talk to, you have medical device companies who think that this movement isn't a big deal and that they're insulated from this. But there are some, Medtronic, for example, they have purchased their own line of, for lack of a better term, like a generic hip and knee replacement products. And they also offer a consulting service that can help folks manage their payment risk under those bundle payment models. So, I think efforts like that are really important, and are some things that you guys should look out for. And then you can see just some of the concepts, the general value-based purchasing concepts there. Site-neutral payments, that's become a big one. You have Congress has already passed a site neutrality law that is aiming to establish some neutrality between what physicians are paid and what hospitals are paid. Typically, hospitals get paid much more for performing the procedures than a physician clinic would. So there's some movement there. I think that's going to grow. You're starting to see CMS trying to downstream procedures from inpatient hospital. For example, they just took knee replacements off their inpatient-only list, which means that those are going to start to move downstream to be done on an outpatient basis, when appropriate, of course. And there's also some talk of moving those further downstream into ambulatory surgical centers, where those procedures are performed at even a greater discount than relative to the outpatient side. And you can see MACRA, this is sort of a busy slide, but MACRA is a very busy law. One of the things that this law, a key feature, is that it will pay physicians who are involved in an alternative payment model, bundling ACOs, what have you, a 5% bonus just right off the board. Just for participating. You still have to manage your payment risk under that arrangement, but you get a 5% bonus. The other option is to stay in typical fee-for-service under what's called the merit-based incentive payment system, where you still get paid by procedure, but there's also layered on top of that this very onerous reporting and sort of quality metrics that you have to abide by. And if you perform poorly on those metrics, you face a potentially large payment cut. If you do well, you could get a bonus, but the bonuses are funded by the penalties. So you only do well if others do very poorly on that. So it's seen as a very very onerous, very negative space to be in, and the thought is that this is going to drive folks further into that advanced alternative payment model stream. And this is just a general overview. We have much deeper experience. I'm happy to talk about any particular reimbursement or coverage questions that you all may have, and I'll go ahead and open it to questions.
Great. Now, I can't remember what happened to the microphone. Any questions? I think as we are quite behind time.
Just Mike's right here. Yeah, well, the president's made a lot of noise about prescription drug prices, but when we go through the system, as you've quite rightly pointed out, keeping patients out of the hospital seems like the big ground that you need to cover within the system in order to make books balance in a way, which the shift to value-based care seems to address. But we're 1/3 on value-based care systems right now, or payment systems at least, yet you don't really, I don't know, are you starting to see that impact? Because healthcare spending as a percent of budget, so on, still seems to be going up. So is that just smoke and mirrors, really, is what I'm trying to
those programs that have been out there so far have not had great results. And I think one of the reasons is that they, so for ACOs right now, organizations have the ability to join one of those programs or form one of those organizations, but they don't have to take on any downside risk. So if you perform poorly, you don't meet your benchmarks, you don't have to pay back the government. You don't pay a penalty to the government. They are set to end that next year, and only those risk-bearing models are able to qualify for that advanced alternative payment model stream. So yeah, I mean, I totally agree that we haven't seen great results yet. Healthcare spending is obviously growing quite rapidly, but I think that with MACRA, giving more incentives for folks to jump into those models, and then this sort of transformation of these programs to like pure risk-bearing mode is going to have some impact.
All right, well, I think we'll draw this session to a close. But Rob, thank you very much. And we have one more before coffee break. So I'm going to invite Byron Callan up onto the lectern to take us through defence and industrial policy.
Great. Thanks, everybody. Daisy, how much time do we have? I can gate it if you want to give me an end mark.
Whatever the quickest. I mean, coffee will overrun, so you don't need to worry too much about 10, 15.
Okay, I'll try and move through this.
You are very kind.
A couple of people walked in, just very brief explanation on Capital Alpha Partners. 10 analysts, Washington, D.C. based. If Washington, D.C. touches something and it has investment implications, we try and have a view or form a view on it. We cover these verticals, but I think, as Rob mentioned, there are a lot of other issues, cybersecurity, trade policy, immigration and labor that we also will consider and will attempt to have a view on. My background, just briefly, I'm a little different than some of the other principals at Capital Alpha Partners. Most of the people came from congressional backgrounds. I was both sell-side and buy-side for 25 years before joining Capital Alpha Partners at Merrill Lynch and Perello Meinberg Partners, Prudential, mainly covering aerospace defense, but also multi-industry and engineering construction companies at one point in my career. I want to talk just briefly about edge, because you all have to talk about your edge and your investment processes, and I think it's important when you think about independent research, what's your edge? What do you kind of bring to the market that other people don't bring? I think, the most important thing for me is being in Washington, D.C. It's really trying to take what you see out of Washington, D.C. and apply it back to companies from equities and a credit standpoint. There are not a lot of people who do this, and you're going to have 20, 30 people covering a stock like Boeing or BAE Systems. Well, there's a tremendous information flow that comes out of Washington, D.C. that I just don't see people tapping into, and I'm actually happiest when I go to an event and there's not another financial analyst there, which is usually most of the time. I'd also point out that this just isn't U.S. information flow. I'm a member of the Atlantic Council. It's kind of like Chatham House. So, for example, last week there was an event at the Swedish Embassy talking about Swedish defense policy. Has no relevance to what's going on from a Washington, D.C. standpoint, but a lot of relevance if you own Saab Group or you're looking at Rheinmetall or some of the other European stocks and how they play. I also do primers, and I think that's an important point, because I remember when I was on the buy side, if someone handed me, hey, go understand the trucking market or the chemical market or, God help me, the biotechnology market, just getting into a basic understanding of how defense budgets work, what do you really look at? How do you come up to speed so you can have a confident, informed discussion with a management or another analyst? I think is a very important service that we add, and we can do that across verticals. I have an annual 120-page. It's a PowerPoint primer, not a single text primer on defense, but I'll get one out on trade and infrastructure policy. We've talked about as a firm, just kind of doing this across all our verticals, because I think one of the biggest services we can do is bring you all up to speed and help you make better informed decisions. I think the other point to start with, I like to think a lot about consensus expectations and try and frame that first, not to take a contrarian position just to be a contrarian, but what do I think the market is currently discounting? What do I think people generally believe? And where, from that Washington, D.C. perspective, do I see seams or things that might be different? I think right now it's fair to say defense stocks have generally been doing quite well on this notion of the world's most dangerous place. You've got growth in U.S. defense spending. NATO is committed to this 2 and 20 goal, not a hedge fund goal, but 2% of GDP, 20% to investment. And on infrastructure and trade policy, maybe the nuances, there aren't as hard a consensus as I see in defense. That may be a little bit looser, but this is kind of what I see from, what I read and then what I have conversations, what I hear from investors on the buy side and what I frankly hear sometimes from the sell side. My own view, let me walk through defense first, then I can talk a bit about trade and infrastructure. Look, I don't disagree with the plan that was just released by the administration, but I think we are entering a period here where there's a disconnect between what the DoD is planning for and where people think defense is going to grow. And this kind of blows back into some of the macro underlying assumptions that are in the U.S. defense spending, the U.S. federal budget, kind of a steady 3% real growth rate. Interest rate projections in the latest plan that were, they've now been breached, I think, on the 10-year. Deficits that are twice what they were last year. And I think at some point this is going to start to bear more heavily on U.S. defense budget growth expectations. I think that's going to have some repercussions that investors are going to have to start thinking through on how they think about individual companies, and then, of course, how they think about the overall growth rates and valuation in this sector. The biggest variable, obviously, the thing that could absolutely upset that is a conflict or conflict risk. I didn't hear the morning session, but I gather that was discussed, this kind of where's U.S. leadership, how are some of these crises being contained? To Rob's point, maybe we're a tweet away from something really bad happening somewhere in the world. And I think that's kind of a very powerful underpinning for defense, but there's a fiscal reality that bears on defense as well, too. I can go through this. Court has the slides, but I also try and think in probabilities and scenarios, and I think that's not just me, but we do a lot of probability work on what we think outcomes are going to be. I don't think it's always good to say, here's how we see the world. with a 100% confidence rate. We'll try and measure our confidence and our intervals, and again, that may provide some different views, but what I tried to do here was just say, I think there's a consensus, kind of steady 5-6% growth rate after a big bump up in 2018. As I mentioned, the latest plan from the Department of Defense is kind of well below those numbers. You could paint a war scenario, and all I took was some of the growth rates you saw in the Vietnam conflict and applied that to investment spending in the U.S. If you're super bullish on this sector, maybe super bearish on the rest of the market. And, if we're in one of the longest economic expansions in the U.S. history, if that comes cropper, then maybe there's a downside scenario for defense to consider as well, too. I don't cover Kodak. I put this slide up because it's a big issue right now in the Department of Defense. You've got new leadership that's come in. They are keenly interested in driving innovation because national defense strategies came out. There's a recognition that we're kind of moving from these lower level type conflicts in the Middle East and Afghanistan into more peer or state-on-state competition. I actually pulled Kodak because the Deputy Secretary of Defense, Pat Shanahan, had mentioned this at a Navy speech 2 weeks ago in San Diego. He said, we don't want to be Kodak. And I know what he was meaning when he drove at this. Kodak in 2000 was a $13-14 billion a year company. They continue to talk about being innovative, but they've been completely outclassed by all the stuff we see, mobile phones, all the other innovation that's out there. So there's a shift going on in the Department of Defense that I'm spending a lot more time, I believe, than my other analyst competitors on the sell side, trying to think through, well, where will this innovation play through? If you're dealing, this may get to, if you're dealing with a conventional threat, how are you going to start to address that? One other point, this is data from the International Institute of Strategic Studies here in London. They just released their 2018 report. A lot of people will focus on defense spending data and talk about global growth rates. I think it's very important to understand, the U.S. is the largest defense spender in the world right now, over $600 billion. And then countries fall off pretty quickly on there. You have to start getting into purchasing parity. What are individual threats? Why is this so costly to prepare against? And there aren't a lot of good public sources on defense spending, but to kind of peel this back and really understand what's driving global spending, in the U.S. we spend $602 billion, $603 billion in 2017 on defense. Well, $48 billion of that went to Afghanistan, and that's against an adversary, the Taliban, that isn't even listed by the ISS. So thinking through global growth rates and defense spending, what's going to drive European, Asian, Middle Eastern, U.S. defense spending is something I spend a lot of my time thinking about. Another point, kind of defense spending drivers may not show up well on the slide, but the one in the upper left-hand corner is from a RAND Corporation report. It's basically the range and saturation rates of Chinese surface-to-surface missiles. And there has been a dramatic change in Chinese military capabilities. I think that's what you're seeing a lot of the U.S. response to. The upper right-hand corner is an image of it was a drone. There were, I think, 15 of them that were launched against a Russian base in Syria recently. And it's this idea of the weaponization of everything, that people can put together relatively extremely low-cost systems and have a military effect from them. So what does that drive? Who will benefit as the U.S. now starts to confront these things the way the Russians have confronted them? There's another theme I'm working with, which is really the globalization of this sector. There's some really interesting things going on in the Turkish defense industry, and I put South Korea, Japan, Israel still, Saudi Arabia is another point. And then the other part of this is really trying to link in some of these geopolitical trends that are going on and how will that impact defense. I was at an event 2 weeks ago in Washington, D.C. Very senior former U.S. official talked about Ethiopia, Sudan, and Egypt is kind of becoming the next pressure point between this broader sectarian competition between Saudi Arabia and Iran. And I can go into some of the details. Should probably throw in Eritrea as a coded part of that map, but I took it out of The Economist. So again, who would benefit from that? How could that change demand, not just for the U.S., but for European or Middle Eastern companies as well? I spent a lot of time thinking about catalysts, particularly for major defense competitions. I publish this list every month and update it. Not all of these are going to move individual companies, but in some instances, there may be a competition coming up where the decision is going to have a material impact on a company's earnings expectations if it wins or loses that program. And there may be secondary or tertiary impacts that kind of roll through industry depending on what happens. So, when you get, these are fairly broad right now, but I mean, some of these competitions, you literally get to a point where you know the day that it's going to be announced. And any of you that like to look at event-driven or very catalytic, discrete events, something else we spend time doing. And the list does go out through 2022, but probably could take it further. We're obviously not a broker-dealer. We don't recommend stocks per se, but I do have views on where I think there's some variant perceptions on where consensus is right now, where I think people ought to be doing work, either to confirm expectations or maybe think about some different angles here. BAE Systems just reported results. Market greeted it negatively. They've kind of painted themselves in this corner where Typhoon, or the Typhoon program, has been a major perception driver of the company. But if you step back, go to that prior list and look at the number of campaigns that they're currently involved in, where it won't impact 2018, may not really impact 2019, but it could have a material impact on their longer term growth expectations. And I just haven't seen a lot of that dialed into the way people think about BAE Systems. So those are the kind of things when I put this list out, it's like, hey, take a look at this part of the company, what's driving, what could change, and maybe give you some dates when those changes come through. I put hiring for the B-21 program at Northrop Grumman. A big issue, I think, coming up for U.S. defense companies is going to be talent. A lot of interest in the U.S. defense sector in autonomy, artificial intelligence, data analytics. They're going to be competing against the commercial sector for this. And I don't worry about it for companies like shipbuilders or armored vehicle manufacturers because they're really good, well-paying jobs. But at the high-tech sector, I think it's going to be a really important discriminator into who does well and who maybe falters relative to expectations. Infrastructure. From afar, you hear, well, U.S. is going to spend $1 trillion or $1.5 trillion or $1.7 trillion on infrastructure. And then you dig into the budget numbers and you realize, no, it's really only about $200 billion that the administration hopes to have levered through state and local and public-private partnerships up to that $1.5 trillion, $1.7 trillion figure. When the budget came out, I go through the budget documents, and this is probably, these numbers were pulled out at probably page 320 of a 600-page OMB document, Office of Management and Budget. What you quickly realize, I don't think you're going to see much on infrastructure this year in the United States. And last year, when the administration talked about infrastructure, their initial approach was to focus on public-private partnerships. So you heard all these rural constituents, their congressmen, their senators say, doesn't work. You can't put a toll road out in farmland. The administration needed to get buy-in, and what they did, the green bar shows how the administration planned to spend this $200 billion in infrastructure spend. This next fiscal year, the U.S. government works on a fiscal year that will begin October 1st, so October 1st, 2018, they were going to throw about $42 billion in infrastructure spending at rural areas. And the blue states, the states like California, New York, Massachusetts, Minnesota, Washington, that money was going to come much later. And when I saw this number, to me, it was like, there's no way in hell you're going to get bipartisan support for an administration plan that front loads all this money for rural constituencies, which tend to be more GOP or conservative in nature, and shortchange the Democratic area. So I think we might get some regulatory relief, but I wouldn't expect to see, you know, the massive funds that have been kicked around in the press flowing to infrastructure this year. On trade, look, this is one of these days, probably as I'm speaking, the administration is coming out and announcing they're going to put 25% tariff on steel imports and a 10% tariff on aluminum imports, which is interesting because this goes back to these Section 232 reports that have been produced basically by the Commerce Department to recommend measures to preserve these industries as vital national security interests. I know from people in the Department of Defense that the steel thing was not an issue for them. So this became more of a political battle. It's going to be interesting to see how this plays out. On NAFTA, I think we're at a window that is rapidly closing where there is a real threat that the U.S. could announce withdrawal from NAFTA as a negotiating ploy to try and bring Mexico and Canada to U.S. positions that, frankly, Mexico and Canada aren't going to go to. I think, you know, the most likely outcome on NAFTA is there are negotiations this week in Mexico City. You know, there's a recognition that you're going to run into the Mexican election on July 1st this year, so probably not a lot is going to get done. I think there's a real political element to the NAFTA negotiations too, which is there's a really negative impact on agricultural states where you have GOP leadership up for re-election in the midterm elections. So if, and I see it more and more and more where Republicans in the United States have become very outspoken against pulling out of NAFTA because the impact that will have on agricultural economy in the states. And that's why I think, as much as there's been a lot of concern about this happening, I'm more concerned about the impact of the steel and aluminum tariffs than I am about NAFTA as a major trade issue. Daisy, I didn't quite do it, but I tried.
You did very well, though.
Okay.
You did very well. And I must apologise about how cold it is in here. We have asked them to turn the heating up. Coffee is being served. Thank you so much. I'm sure.
Yeah,
that
catch me out there.
Outside or afterwards, that we can facilitate that. But thank you very, very much.
Thank you, Daisy.
Let's show our appreciation, ladies and gentlemen. Thank you.